Many of the large economies around the world seem to be flirting with recession, and with Trump's actions over recent weeks stoking major uncertainty around the world, it's looking more and more likely that some of the world's largest economies, especially the US, may soon fall into a recession. But the question is, what's the correlation between the performance of the stock market and the performance of the wider economy? In other words, if we do enter a recession, will the stock market inevitably crash, or could it weather the storm? Hi everyone, welcome back to the channel. My name's George, and as someone invested in the stock market, I often find myself wondering how the performance of the stock market is linked to the wider economy. It makes sense that in good times, the stock market will be performing well, as businesses are making lots of money and people have the confidence to invest. Whereas in bad times, the stock market will fall as businesses' profits dry up and investors look towards safer assets like cash or gold. But is this always the case? And if we do enter a period of recession, can we expect the stock market to crash? Well, to begin answering this question, we first need to take a look at what a recession actually is and how a recession can affect the stock market. Now, the term recession gets thrown around a lot, but as many of you will know, it does actually have a technical definition. Most economists will define a recession as at least 2 consecutive quarters of a decline in a country's gross domestic product, or GDP. And we can basically think of GDP as all of the stuff that's produced within a country's borders. So all of the products and all of the services which are produced in a country over a given period of time. So a recession is essentially a reduction in the amount of stuff that's produced by a country over the course of 2 quarters or longer. And this has lots of implications and knock-on effects. For example, when GDP shrinks, this basically means that businesses are producing less products and services in general. So many businesses will therefore need fewer workers. This then leads to some people being made redundant and losing their jobs. And these people then might struggle to find new work as businesses are producing less and so are less likely to be hiring. These people who are unemployed and struggling to find work will inevitably spend less money in the economy, which means that businesses' incomes will drop, which means that they might cut more staff in order to save on costs, meaning that more people are unemployed, making the situation worse. So it's easy to see how an economy can get itself into a vicious cycle. You know, unemployed people tend to spend less, meaning that businesses will make less, meaning that more people will be unemployed, and so on. But it's worth noting that the economy is a complicated beast, and this unemployment cycle is just one example of how an economy can be affected by a recession. But in general, in a recession, we can be expecting people to be spending less money, meaning that businesses will make less money, and some will even go bankrupt. So what effect might this have on the stock market? Surely it means that the stock market will start to perform badly. Well, potentially, but that's not always the case. Now, it seems pretty obvious that during a recession, the stock market should fall, as businesses will be making less money, and as stock prices are theoretically based on a business's profits, then stock prices generally should be lower. However, this isn't necessarily the case for 2 main reasons. Firstly, the stock market is forward-looking. It reflects expectations rather than current conditions. Think of it like this. Every share price is basically a prediction of a company's future cash flows, basically their future profits. So if investors think that a company's profits are going to drop from 6 to 12 months' time due to a recession, then they'll start to sell today, pushing the share prices down before the recession even hits. And conversely, if the economy is within a deep recession, the stock market can go on a massive rally if investors expect things to pick back up as the economy recovers. Take the example of when COVID first hit back in early 2020. Stock markets around the world had begun to crash as early as the middle of February, while the number of people that had actually caught COVID at this point was still super low. In other words, the stock markets were pricing in the potential future impacts of COVID and COVID restrictions weeks before any actual COVID restrictions or COVID lockdowns had actually come into effect. Then fast forward to late March 2020, the markets were suddenly shooting back up again as the governments announced generous stimulus packages to keep the economy afloat, while at the same time COVID restrictions and lockdowns were really only starting to come into effect. So the effects on the actual economy were only just beginning. So what this example is showing is that the stock market is not the same as the real economy. By the time the economy was being meaningfully impacted by COVID and COVID restrictions, the stock market had already crashed weeks earlier and had already started on its road to recovery. In other words, the stock market will tend to move much before the real economy does, as the stock market is all based on expectations rather than what's actually happening in the present day. And we can see this happening today. As Trump changes his mind about the tariffs every 5 minutes, the stock markets will move wildly in response, even if the tariffs have not even been implemented yet. And the second reason why the stock market doesn't always match up with the real economy is because the stock market is generally owned by rich and very rich people, and these people tend to be affected very differently by a recession than the majority of the population. If we look at the US in particular, the top 10% of wealth holders own 89% of all of the stocks owned by Americans. And as these people are generally insulated from the economic pain of a recession, as they've got plenty of money to act as a buffer, then it doesn't necessarily mean that the stock market will feel the same pain as the wider economy. For example, if the economy is in a deep recession and unemployment rates are high, if rich investors believe that the largest companies can remain profitable, then the stock market can stay afloat even during these tough economic times. Again, going back to the beginning of COVID, in the second quarter of 2020, the US economy shrunk by a massive 7.5%. But over the same time period, the stock market actually grew by 2%, which just shows how a contraction in GDP doesn't necessarily correlate to a stock market crash, as rich investors were generally insulated from the economic hardship of lockdowns and had confidence that the largest businesses would remain profitable thanks to the generous stimulus handouts from the US government. So we've discussed what could happen to the stock market during a recession, but how should you as an investor behave if these tough times were to materialise? So recessions and market crashes have happened many times before, and they'll happen many times in the future. And it's only human nature to feel anxious and want to cut our losses and sell our investments when we see them start to fall. But it's important to remind ourselves that investing is a long-term game, precisely because of the inevitability of market crashes and recessions, as staying invested over the long term gives us time to ride out the ups and downs in the market. And I think it's also good to remember that market crashes can actually present a golden opportunity to buy into the market, as stocks will be available at a discount when markets are lower. And a lot of investors will do this. They'll try to time the market and essentially guess when the market will be at its lowest, and then buy in then. However, trying to time the market in this way is usually a mug's game, as trying to predict where the market will hit the bottom is almost impossible, especially in the unpredictable times that we currently live in. So a technique that I like to use during market downturns, and well, all of the time to be honest, is a technique known as dollar cost averaging. And basically what this means is investing a consistent amount at consistent intervals. Say investing £200 at the end of each month, for example. And what this means is that if the markets drop, you'll be benefiting as you'll be picking up stocks for cheap. However, if markets rise, you'll also be benefiting as your existing investments will go up. So the beauty of dollar cost averaging is it allows you to benefit if the market drops and benefit if the market rises. And you don't need to have to worry about trying to time the market in any way. All you're saying is that you'll invest at these specific time intervals. And also, many modern investment platforms will allow you to set up recurring investments which happen automatically. So you can just set it up and forget about it. And then you don't need to worry about the markets anymore, because you can be content in the fact that you'll be benefiting if the markets go down, but you'll also be benefiting if the markets go up. And if you've made it this far, you might find some of our other videos on the channel interesting, as we've got plenty more on the topics of investing and personal finance, and many more in the works to come. And please consider leaving a like and subscribing to the channel if you've enjoyed. Thanks for watching.